This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, what I want to do right now is dive a little bit deeper into some charts and look at these energy markets, both the commodity as well as the stocks in the energy production sector. Listeners, you'll find the chart deck linked in your Research Roundup email. If you don't have a Research Roundup email, it means you're not registered yet at macrovoices.com. Just go to our homepage, click the red button that says Looking for the Downloads. Patrick, the title of the slide deck is Scanning the Energy Markets. Scan away, my friend.
All right. Well, you know what? I wanted to take a deeper dive into the entire energy complex just beyond looking at oil alone. But even on page 2, the first thing we start off with is that oil chart. And we were just talking about it at the start of the show during the market wrap. And you were talking about that you didn't think that there was enough pain yet for a lot of the oil traders off the highs. And I find it really interesting when we look at this chart. What I did is put the volume profiling to show where all the highest volume consolidations have actually happened. And we're right now in this pocket in between, you can round it to this kind of $59 to $64 range where much of the consolidation has occurred. And I find it interesting that we're right in that pocket. And it continues to be like a really important point to find out which way this market breaks higher. Now, I've been a suspect that there's room for us to temporarily dip below 60 and below that 50-day moving average as we, could potentially correct down into the mid 50s on just a little kind of washout of short-term traders before we get an upside. But when we get through the rest of the charts, it's really interesting that many of the other markets have already engaged in this deeper correction, and oil really has not played along. It'll be interesting to see whether this ends up just being a big sideways consolidation in oil, and then somehow a new bull breakout ensues off of that. And so I'm definitely watching that 50-day moving average in this consolidation zone, and it'll be really interesting to see if oil could put together a meaningful breakout above 64. What's your take on that?
Patrick, something I've noticed about oil markets is when you see a sideways consolidation, and a perfect example of this is the one that we had last summer. When you see that sideways consolidation where the market's going to trade sideways for a while and then it's going to move higher, usually what happens is the lowest point in that consolidation, the lowest print that you get comes right at the end, and then it's all uphill from there. We didn't get that this time. We did get a last dip lower, if you will, that we had last week, but it wasn't all the way back down to that 57 spot 24 or whatever the number was from a couple of weeks ago. We haven't had that one last push to a new low, which usually would be, what I would think of as where the consolidation ends and where the uptrend begins. What we've seen here, it's been way too comfortable for me and for the other oil bulls. I don't feel like the weak hands have been shaken out of this market yet. It feels to me like it's still coming.
Well, what I wanted to do is on page 3 talk about the actual crude oil term structure. And obviously, there's a lot of periods where crude oil trades in backwardation, but this is a very clear backwardation. There's not even a little bit of contango at the front of the curve. It's just straight down where the belly of the curve going 3-4 years out is still $50 oil. How do you interpret this, and why do you think it's so steep, or is it steep? Am I just misreading it?
Well, Patrick, let's start by refreshing our listeners' memory on the term structure chart and how it works, because not everybody who is not a commodities trader really has seen this type of chart. Each one of those little yellow dots is the current price of a different crude oil contract. The first dot at the left is the May delivery contract. That's the front month, as we call it, because it's at the front of the queue there. And then each subsequent contract has a price. And if you go 5 years in the future, as you say, the price is only $50 or so. The difference between any 2 months, the 1 month spread, there's a lot of history that I've done a lot of work in analyzing. And, you can easily get to $1, $1.50 per month of backwardation right at the peak backwardation level, which is usually between 6 and 12 months into the future. That's if you start looking at $1.50 of backwardation, that's where you say, okay, this has gone about as far as it could possibly go. We're at we were at 50 to 60 cents per month of backwardation at the peak. And right now we're back to 25 to 40 cents, depending on which month you're looking at. The maximum amount of backwardation between any 2 months right now, as I look at another live chart on my screen here, is 44 cents. So, we're getting there, but this is not super extreme backwardation by any stretch. And again, what drives backwardation is expectations of tightening supply. And I think that we are going to get more expectations of tightening supply after we burn through the excesses that have existed and we start to run into not as much supply because of not as much investment in new production. All of that eventually unwinds and you get really steep backwardation before this is over. I don't think we've seen the max backwardation by any stretch of the imagination yet.
So, Eric, I just wanted to, on page 4, just touch on Brent oil because we talk a lot about WTI and we haven't really shown a chart on Brent oil for a while. But really what I find interesting is that if you go back for the last couple of years, Brent oil and WTI have actually diverged numerous times due to whatever fundamentals. But really, one thing I've noticed is since the November lows till about now, really the two have been trading in lockstep. There haven't been any major divergences between the two. And it'll be really interesting to see whether that continues or whether the fundamentals between the two start to actually have each kind of start marching to the beat of its own drum. But right now, anyway, Brent is just been more or less trading in line. But this is where I wanted to go to chart 5 and look at gasoline futures. And like a month back, I was showing a chart where gasoline has actually been materially outperforming WTI on the upside. We just had a huge surge in gasoline futures. But what's interesting here is that gasoline really has calmed down. We haven't seen any deep pullback here yet. I was suspect that we could see gasoline futures dipping even as low as like 175. But really, at this stage, it has had a very similar consolidation to that of oil itself, which is it's holding above its 50-day moving averages. It's more or less trading sideways in this pocket, and this kind of $2 area for gasoline futures seems to be really where we're pivoting off. It will be really interesting to see whether or not gasoline can break out from here.
Yeah, and something I'm just watching, I'm looking at another chart as we speak. We've already moved below most of the short-term moving averages. The big hurdle that's left is the 55-day moving average, which is about where you've got the 50-day drawn on this chart. We're above it right now, but only by a little bit. If we got a daily close below that, it would open the door to a much bigger move lower. So that's going to be what I'm watching for as the first sign that maybe we are about to see a move to a new lower low in terms of crude oil prices.
Right. And so on page 6, just to continue with that, I have the RBOB Gasoline CRAK spreads, which is sort of the profit margin and one would consider for a lot of these refiners of turning oil into gasoline. And this is just went roaring higher because of that rise in gasoline prices. And it's really interesting that this is just not let up. Right now, these CRAK spreads continue to stay up along the top end of these ranges. And it'll be really interesting to see whether this stays there and whether that means we'll in a few minutes we'll just be looking here actually at the chart on the refiners, and they've been pulling back, but this chart hasn't. It'll be interesting to see whether that proves as a buy on dip opportunity on many of these refining stocks.
Let's take a look at natural gas on page 7.
Right. And so natural gas, has, at least on the surface, appears to have been far more trade range bound than crude oil over the last 6 months. But what is interesting is that the recent pullback in nat gas, this is a continuous futures contract, so it had as much to do with the rolling along the term structure of nat gas as it did with actual real spot prices of gas. What's interesting is when we look on page 8, one can see the term structure of nat gas, which has far more waves. The seasonality of natural gas going a decade out is being reflected in these ups and downs. But what is clear is that we sort of rolled down the term structure from a seasonality perspective, and we're now looking at a scenario where this continuous contract is going to be rolling up the term structure. Right now, pricing in a December contract as high as $3.20. And so it looks like, at least from this chart perspective, that we probably have seen the lower boundaries of natural gas, and we should see it progressing back towards those November and February highs as we get into the third and fourth quarters of the year.
Let's move on to the actual energy stocks using the XLE ETF as a proxy for them.
Right. I want to go through a whole series of these different ETFs that represent the different oil sectors. And this particular one, the XLE, is sort of the best one that encompasses the majors, the fully integrated oil names that have those big juicy dividends. And really what we can see here is that they've been pulling back, and they have actually been making lower lows. And the pullback has been very pronounced in the energy stock sector ever since that March high. But what's interesting is that when we go and compare that to the XOP, which is the Spider Oil and Gas Exploration and Production ETF, this has been an even deeper pullback. I mean, we've seen this ETF pull back from $92 down to a low of $72 during this consolidation. And so what's interesting is that while we've seen those charts on oil and gas actually holding up in the futures market, really these energy stocks have really gone through a deeper and more meaningful pullback that is now longer than a month in duration. It'll be really interesting to see that now that we get many of these pulling back this deep, whether this actually proves as a meaningful buy on dip opportunity on many of these energy names.
Patrick, moving on to slide 11, we've got OSX, the Oil Services ETF. That, of course, includes companies like Halliburton and Schlumberger that provide services to drilling and exploration and refining companies. What are we looking at here?
Right, and this is actually where the correction has even been the deepest. Just a very pronounced pullback in oil service stocks, and we're slowly approaching a 200-day moving average, including where the December and January consolidations all developed. And so now that this pullback has occurred as deep as it has, watching those Schlumbergers and the Halliburtons is going to be really interesting. Well, the other one that's also interesting to look at is on page 12, where I have the actual oil refiners themselves. That's we're using the ETF CRAK, CRAK, and this has actually held up pretty well. But this ETF doesn't actually reflect some of the deeper pullbacks that we've seen in like the Phillips 66 and the Holly Frontiers of the world. With the fact that CRAK spreads are holding up as much as they are, it's curious whether this is going to be a place where there's going to be relative strength or outperformance relative to the other oil areas or sectors in there. And finally, Eric, what I wanted to touch on page 13 is the Alerian MLP ETF. And what's interesting is the MLPs, like the midstream oil pipeline kind of storylines, which we've had Variant Perception guys come on to our podcast and talk about the space. They've actually held up very well. And this ETF is working along its 52-week highs, but and that's reflective of those stocks like Magellan, which are the big giants in these ETFs. But when you go to some of the individual names like the BP Midstream or Phillips 66 Midstream or Shell Midstream, some of them are actually breaking to 52-week highs when they have these big juicy dividends that they pay out, distributions anyway that they pay out. It's really interesting that this particular space has not really been impacted by the correction and continues to do very well.
And listeners, you can get Patrick's graphs and charts not just once a week, but every single day with a free trial of Big Picture Trading. You'll find the information for signing up on page 14 or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.